I was caught in the middle of a transaction in the Philippines when the lockdown happened in Manila.
Sa umpisa, talagang kami ay natakot sa COVID-19.
It isolated me from my family.
Naapektuhan sobra ako sa pandemic talaga. Lahat naman buong mundo naapektuhan.
Someone's always there to help.
Banking with PNB ay tunay na masasandalan kahit sa pandemic.
Mabilis yung pagka-process ng remittance.
Napakabilis ng servisyo.
Laking tulong sa akin ng PNB. Laking tulong nila.
Every time you need help, PNB ang sandalan.
Ang sandalan mo.
Ang sandalan mo.
Ang sandalan mo.
Ang sandalan mo.
Sumandal ka sa akin, uunahin yung kailangan, huwag kang mag-alinlangan. Sumandal ka sa akin, may lalapitan, ikaw naman ang una. Kaya sumandal ka sa akin, uunahin yung kailangan, huwag kang mag-alinlangan. Sumandal ka sa akin, may lalapitan, ikaw naman ang una. Kaya sige, sandal, sandal sa PNB, Philippine National Bank.
I was caught in the middle of a transaction in the Philippines when the lockdown happened in Manila.
Sa umpisa, talagang kami ay natakot sa COVID-19.
It isolated me from my family.
Naapektuhan sobra ako sa pandemic talaga. Lahat naman buong mundo naapektuhan.
Someone's always there to help.
Banking with PNB ay tunay na masasandalan kahit sa pandemic.
Mabilis yung pagka-process ng remittance.
Napakabilis ng servisyo.
Laking tulong sa akin ng PNB. Laking tulong nila.
Every time you need help, PNB ang sandalan.
Ang sandalan mo.
Ang sandalan mo.
Ang sandalan mo.
Ang sandalan mo.
Sumandal ka sa akin, uunahin yung kailangan, huwag kang mag-alinlangan. Sumandal ka sa akin, may lalapitan, ikaw naman ang una. Kaya sumandal ka sa akin, uunahin yung kailangan, huwag kang mag-alinlangan. Sumandal ka sa akin, may lalapitan, ikaw naman ang una. Kaya sige, sandal, sandal sa PNB, Philippine National Bank.
Well, good afternoon, friends and colleagues in the insurance industry. Welcome back to another in the PIRA series of webinars designed to help industry practitioners with the respective tasks and mandates, as well as to equip them with valuable insights from our resource persons who are specialists and experts in the respective fields. This afternoon session is no different. Our friends from the banking industry, specifically the Philippine National Bank, will update us on key themes and economic insights, which will be useful as we navigate through the wake of COVID-19 and the rough waters churned up by geopolitical issues such as the Russia-Ukraine conflict. So to formally open today's activity, we are extremely fortunate to have no other than the President of the Philippine National Bank, Mr. Vic Veloso, with his opening remarks.
A pleasant day to everyone. Thank you for joining today's economic briefing with the Philippine Insurers and Reinsurers Association. We are in the third year of the pandemic, and while infections have subsided and the economy is slowly trying to recover, the challenges can still be overwhelming. We must embrace this new normal and figure out how to make that new reality work for our businesses, our customers, and our people. At PNB, we beefed up our digital offerings to serve the immediate needs of our customers. Our mission is to continuously look for innovative ways to enhance our customers' experience and become a channel for their financial needs. To give us a macro view of the local and global economies, as well as the impact of the ongoing conflict between Russia and Ukraine, is PNB's economist and head of research, Alvin Arroyo. He will discuss the key themes and economic insights that can help drive business strategy through 2022. PNB's multinationals team will also be sharing with you some of our products, which we hope will be helpful. I encourage you to approach them so you can learn more about what we can offer. I ask you to listen to the valuable insights and learnings from our presenters today as they provide you a macro view of the economy and discuss PNB's business solutions for your specific needs. As the economy regains its momentum, PNB will bounce back and focus on initiatives that will take advantage of the opportunities in a landscape that was radically transformed by the pandemic. Once again, welcome everyone to today's economic briefing. Thank you for joining us and enjoy the rest of the day.
Well, thank you, President Veloso. Let us then move on to the main event. Here to give us a brief on the state of our economy at this particular point in our history is no other than PNB's head of research, Mr. Alvin Arroyo. PNB's research division, Financial Management Sector, studies and forecasts key economic data of the Philippines. It also closely analyzes the fundamentals of our companies listed in the Philippine Stock Exchange to identify unbiased equity investment opportunities for PNB and its clients. It is a shared resource for various investment-focused business units and subsidiaries of PNB and is used for both internal decision-making and client relationship building. Alvin's previous experience includes head of research at Credit Suisse Philippines and Philippine Equity Partners, Bank of America Securities Research and Trading Partner. He also used to be the chief investments officer of a Philippine holding company employing a private equity investment strategy. For nearly 15 years, Alvin utilized financial and industry analysis for investment, recommendation, M&A, business development, creditworthiness assessment, and corporate planning. Inclusive of his advisory role, he has over 10 years of experience working in the Philippine stock market. Alvin has a master's in applied economics and dual undergraduate degrees, majoring in applied economics and financial management from De La Salle University in Manila. Ladies and gentlemen, Mr. Alvin Arroyo. Alvin, you have the floor.
Thank you, Sir Michael, for the kind introduction. Let me just share my screen. Sir Michael, just checking if you can see my screen.
Yes, and we can hear you clearly.
Okay, perfect. Good afternoon, everyone, and thank you for inviting us again to do this economic briefing for the members of PIRA. My discussion will be divided into two major sections. First is regarding the Philippines economic environment, and second is on the Philippine financial markets, covering the benchmark interest rates, the exchange rate, and the Philippine Stock Exchange Index. So a quick summary, the GDP, or the gross domestic product, which is the broadest measure of our economy, I think there is a perceptible path towards the benign phase of COVID. And this should allow the government to further ease mobility restrictions for the most part of this year. As a result, the demand for non-essential items and those that were hampered by social distancing, particularly the tourism and the recreation sectors, would start recovering at a faster pace. Given this, our GDP growth forecast is 6.6% for 2022, and we estimate that our economy as a whole will return to the pre-pandemic level by the third quarter of this year. The main problem this year, however, is inflation, or the rate of increase in consumer prices. We forecast an average inflation rate of 4.7% this year, and it could be even higher under a prolonged Russia-Ukraine war. This number is significant because the BSP has a target of 2 to 4%. So anytime inflation exceeds 4%, that is considered unhealthy for the economy. Unfortunately, because of the Russia-Ukraine war adding to the supply chain problems, we believe inflation will be over 4% in the coming 13 months. Consequently, we think that the BSP will start its tightening of the monetary policy, particularly increasing its policy rate. So the BSP's policy rate is the overnight reverse repurchase rate, or RRP rate, and it is currently at 2%. We think there will be 25 basis points rate hikes this year, which means that we will end the year at 2.5%. For financial markets, loans and any commercial interest rates are typically set relative to the BVAL, or the Philippines benchmark interest rates. Our view is that the short-term BVAL will follow the policy rate adjustments. Meanwhile, the yield curve would likely remain steep, meaning the longer tenors would be higher than the shorter tenors due to the national government's borrowing requirements and the pressure from the US benchmark. We forecast that the one-year BVAL will increase to about 2.7% by the end of the year, and the 10-year BVAL to climb at 6.5%. For the exchange rate, the earlier and larger Fed rate hike, compared to the BSP at least, is happening or will happen due to the earlier economic recovery and larger inflation in the US. We also have a very high real demand for dollars, as evidenced by the high trade deficit. As a result, we believe the peso will continue to depreciate to a range of 51.8 to 53.8, and by the year end settle at 52.8. Finally, for the Philippine stock market, we think that the wide trading range will continue, anywhere from 6.8 to 7.5. If we compare our forecast, we are more conservative than the government. So the government officially looks at the GDP growth of 7 to 9% because of the impact of the Russia-Ukraine crisis on the prices of goods. I don't think that is achievable. So for us, 6.6% growth is still good, but the government forecast of 7 to 9%, I think, is not achievable. Inflation, the BSP is looking at a 4.3% rate, and the government, like I said, would typically want inflation to range between 2 to 4%, but that is not likely to happen this year. So before I continue with our GDP, inflation, and policy rate forecast, let me first discuss our take on the impact of the Russia-Ukraine war. So the main disruption will be the increased risk of higher inflation. This is because Russia is the world's third largest producer of petroleum, and Russia and Ukraine combined account for about 30% of global wheat exports. As a result, Dubai crude climbed to about $107, or up by about 40% year to date, while wheat is now at $10.6, or up by about 37%. These were the prices as of April 4. In addition to that, other commodities have followed suit, and Philippines is a net importer of these commodities, particularly crude and wheat. As a result, as you can see from this chart, there is a strong positive correlation with the prices. Our inflation has a strong positive correlation, or relationship with the prices of crude and wheat, and therefore with these commodity prices remaining elevated, we think inflation also would remain high. The good news, however, is that in terms of the direct disturbance, so if we don't look at prices but look at exports and remittances, the Philippines' exposure is actually very minimal. Russia and Ukraine would only be about 1% of our exports and remittances. So in terms of the direct impact, it's quite manageable. The issue really is the second round effects, and that's because Europe accounts for about 13% of our exports and 12% of our remittances. And of course, because of the war and the ensuing high prices, we can expect lower business and consumer confidence in Europe. And as a result, that represents a bigger drag on our exports and remittances. So in short, the direct impact of the Russia-Ukraine war is conflict, but the indirect impact through inflation is very significant. And the first round or the second round effects to Europe would have a disturbance to our exports and remittances. So moving on to our GDP growth outlook. First, it is important to recall that in the fourth quarter of this year, of last year rather, the Philippine economy expanded for the third straight period with a GDP growth of 7.7%. Combining that with the 4.8% growth during the first 9 months of last year, brought the full year growth in 2021 to 5.6%. Looking at the various sectors, the good news is that there are now more sectors that are close to full recovery. So that includes agriculture, forestry, fishing, retail trade, and manufacturing. Those that were really resilient have not changed, meaning the following sectors have benefited from the pandemic: information and communication, human health and social work activities, finance and insurance activities, public spending, as well as electricity and utilities. What is obvious is that the industries that are highly dependent on mobility, like accommodation and food service activities, transportation and storage, construction, and real estate were still below, no, substantially below where they were before the pandemic started. Fortunately, if the loose restrictions continue, we expect these sectors that were heavily hit by the pandemic to recover at a faster pace this year. So for our baseline scenario, we have a forecast of 6.6% growth for this year. What we assume is that in the event of a new surge in COVID cases, the Philippines will not adopt a zero COVID policy like we're seeing in China. Instead, we believe that just like in the latter part of 2021, the Philippines will implement balanced mobility restrictions, meaning not completely close the economy. The key assumption here is that the new variants, even though they might be more contagious, no, like the Omicron XE variant, that they are not deadlier than the current variants. So as long as hospitalizations are kept at a minimum and severe to deadly complications are minimal, I think the Philippines, because it doesn't have a zero COVID policy, will not implement draconian lockdowns in the event of a surge in new COVID cases. Obviously, our forecast will be challenged if the new variant becomes deadlier creates more serious complications than what we are seeing at the moment. So for us, it's not it's not how contagious the virus is that's more important. It's the complication of the new variants. So as mentioned a while ago, we do think that the sectors that were hurt by the pandemic the most, like transport, recreation, and culture, and restaurants and hotels, will recover at a faster pace this year. So for transport, we forecast an 8% growth, recreation and culture, 13% growth, restaurants and hotels, 11% growth. So this will be higher than the overall growth of the Philippines, but that is a product of them or of these sectors being hurt the most, and therefore once the economy reopens, they would also, in terms of the recovery, be faster than the overall average. So in terms of the overall economic recovery, as of the fourth quarter of last year, our GDP was 4.5% below the pre-pandemic level. However, because we are seeing a 6.6% growth this year, if we combine that with the 5.6% growth last year, and the fact that our economy fell by close to 10% in 2020, our estimate is that in terms of the economic or in peso terms, after adjusting for inflation, our estimate is that our economy will return to the pre-pandemic level by the third quarter of this year. Okay, so moving on to inflation, which for us is a more important issue this year than growth. Inflation, or the increase in consumer prices, accelerated to 4% in March from 3% in February. The consumer price basket items with the highest increase are transport, utilities and fuels, and food and non-alcoholic beverages. The climb in the Dubai crude oil resulted in the further surge in the prices of diesel, LPG, and gasoline, and I think we're all aware of that. Moreover, the spike in Newcastle coal helped push electricity inflation higher. Meanwhile, the key food items that contributed the most to faster price increases were meat, fish, and other seafoods. So the quick increase or the meaningful increase rather in the March inflation figure demonstrated how quick inflation adjusts to global to global commodity prices, particularly oil. As such, our view is that the monthly inflation figures will exceed the target of the BSP in the coming 13 months. No? And this fact becomes important as we discuss interest rates. Our estimates consider the latest domestic supply demand conditions and implicitly budget for significant increases in key commodities. So, for example, our inflation forecast assumes that Dubai crude oil will have an average of $110 per barrel this year, or a 60% growth compared to the average price of crude in 2021. So having said that, we have an average inflation forecast of 4.7% for 2022 and 3.9% forecast for 2023. Indeed, no, our view is not unique. On March 24, the BSP actually raised as well their average inflation forecast to 4.3% for 2022 and to 3.6% for 2023. Our forecast is a bit higher because in our view, the second round effects are actually going to be worse than I think what the central bank is currently anticipating. For my final slide regarding the Philippine economic environment, I will discuss our view regarding the country's monetary policy. So before the pandemic, the BSP's policy rate stood at 4%. And this was cut by a total of 200 basis points to help our economy traverse the financial impact of the virus, which means that the RRP rate was cut to a historic low, I should note, of 2% by November of 2020. Now, last year, even though inflation was high, the central bank kept the policy rate unchanged at 2% in order to help keep borrowing costs low and to continue its monetary support for the country's economic recovery. However, since the Philippine economy is poised to recover all lost ground by the third quarter of this year, plus the lingering inflation problem, we believe that the central bank has no choice but to increase interest rates this year. So our forecast, like I have said a while ago, is for the policy rate to increase to 2.5% by the end of this year from the current level of 2%. The BSP also has to incorporate what is happening in the US. The United States Central Bank, or the Fed, already started their interest rate hike cycle by a total of 25 basis points. And they said that at least 150 basis points more will happen this year. Our forecast for a total Fed rate hike this year is about 150 to 200 basis points. So let's now move to our view regarding the financial markets. So for the Philippines, commercial rates, like lending rates, are benchmarked against the BVAL. And we believe that the short-term BVAL rates will follow the policy rate adjustments both here and in the US. This chart shows the positive relationship between the RRP rate, or our policy rate, and the one-year BVAL, confirming the effectiveness of the BSP's ability to influence short-term market interest rates. So in line with our view of a policy rate hike this year, plus the pressure from the US Fed, our forecast is that the one-year BVAL could reach 2.7% by the end of 2022, or 100 basis points higher than its end 2021 level of 1.7%. We don't consider, however, the 2.7% as the maximum. As you can see from this chart, the 1-year BVAL can materially overshoot the RRP rate when there is a strong pressure from US interest rates. So if we extend our analysis to the entirety of the yield curve, our view, at least as a baseline, is that the Philippines yield curve would likely remain steep. And in addition to the pressure from the US, the budget deficit this year, or the difference between government expenditures with the revenue collections from the government, would likely remain about 2.5 times higher than it was during 2019. So given these two factors, we have a baseline forecast that the 10-year benchmark rates could reach 6.5% by the end of 2022, or 170 basis points higher than its end 2021 level of 4.8%. For context, the 10-year BVAL is currently now at 6%. And during the last high inflation episode, which was in 2018, the 10-year BVAL ended at 7.1%, but during that year actually traded higher. So shifting our discussion to the Philippine peso, we believe, like I said at the beginning of this presentation, that our currency will continue to depreciate. And this is because of two things. First is that there will be an earlier and larger Fed rate hike in the US, meaning the movements in the short-term interest rates in the US has already begun. And the total moves this year will be larger than the Philippines. And this is because, unlike the Philippines, which is still below the pre-pandemic level, the US economy as of end of 2021 was already 3.1% above 2019. So they have already recovered. Secondly, the inflation rate in the US is almost double that of the Philippines. So for the Philippines, the latest inflation rate is 4%. In the US, it's 7.9%. As a result, the central bank in the US will increase rates faster than the Philippines. The implication of this is that the flow of money market investments in favor of US dollar instruments will be stronger, and therefore result in a stronger dollar. And given that, we believe the peso will be weaker. This situation that we are painting is actually not the first time that has happened in the recent past. So the chart I'm showing you now is that in 2017 to mid-2018, we also had a situation in which the Fed rate hike cycle was met by a more accommodative BSP. And coupled with the high trade deficit, we saw back then the peso weakening all the way to the 54 level. So the same ingredients are here this year. And so we think the peso will also continue to weaken in 2022. Another driver of the weaker peso and a stronger dollar is the trade deficit, which we, as we can see from this chart, have seen record high levels in December and January of this year. So with the excess of imports over exports, the widening trade balance creates a stronger demand for dollars, and therefore weakens the peso. And we have seen this again happen in 2018. And this has been a major contributing factor for the peso weakening up to the 54 level during that period. So for my final two slides, no, let me tackle the Philippine Stock Exchange. So the main index, or the PSEI, fluctuated at a broad range in 2021. And this can be attributed to the big shifts in new COVID cases, which in turn influence the level of mobility restrictions and its consequent effects to our economic activity. For this year, although there is a perceptible path towards the benign phase of COVID, there are two key sources of uncertainties for equity investors. First is the transition to a new president, and second is the Russia-Ukraine war. As such, we believe that the PSEI will continue to trade at a wide range, and we have a base case fair value of 7.5 and a support of 6.8. If the 7.5 is breached, for example, if we have a very smooth transition to a new president or a quick resolution to the Russia-Ukraine conflict, then our bull case of about 8.2 is still achievable. So that's my final slide for this afternoon. Again, thank you for providing PNB the opportunity to share our economic and financial market outlook. I now turn over our floor to Sir Mike. Thank you.
Thank you very much, Alvin. It was very interesting and thought-provoking. Ladies and gentlemen, hold on to those questions until after our next speaker is done. So now, to help us navigate and address some of the pain points our various stakeholders have, we are also very fortunate to have PNB's relationship officer from the multinational division talk about their bank's debit card and prepaid card solution. Miguel comes from PNB's multinationals division of the global banking and marketing sector. It caters to the multinational BPO industry in the Philippines. The division primarily offers non-credit related products and services such as cash management and ecosystem solutions. It also fronts and cross-sells the bank's other products and services that would match the client's banking needs and requirements. Miguel Veneracion, a graduate of De La Salle University, Manila, with a degree in BS Business Management, was a member of PNB's Junior Executive Development Institute program. He joined the Multinationals Division in 2020 as a relationship and sales officer, and his speaking brand is spot on for a variety of areas due to his training in different areas of cash management solutions. Today, he would share with us his insights on the robustness, multifaceted, and effectivity of PNB's card solutions. So Miguel, you have the floor.
All right. Thank you, Sir Mike, for that wonderful introduction. I'd also like to thank everyone here for joining us. So right now, I would like to present our prepaid and debit card solutions. I'll be sharing my screen right now. Let me know if you can see it.
Yes, Miguel, we can see it.
All right. So to begin, our PNB debit card and prepaid card solutions. So first, I'd like to introduce our PNB prepaid MasterCard. Our PNB prepaid MasterCard is a reloadable card that enables you to access your cash and use it via POS, internet, or mobile banking, as well as withdraw cash from any ATM here in the Philippines. One of the few benefits that you gain is the need for you not to open a bank account. There are also no credit approvals needed in opening a prepaid card. And basically, it's like having a credit card without the element of debt. Now, our prepaid MasterCard benefits not only individuals, it also benefits companies who are interested to purchase or avail this facility. Now, for retail card holders, it allows them an easy access to cash and withdraw through any BankNet ATM here in the Philippines or worldwide. Another thing that our retail customers can enjoy is its worldwide acceptance. Given that the prepaid card is a MasterCard branded card, it is recognized and usable in all MasterCard affiliated stores around the world. And given the new normal, it is now the modern way to handle money. Now, for companies who also want to avail, it allows them an easy access to streamline their processing of disbursements. And our product allows them a same-day credit service for their agents or commissions to their agents. Our PNB prepaid MasterCard is also recognized given it's MasterCard branded and a PNB card. Now, to give a brief overview of how our company clients can issue or can avail our product, all they need to do is accomplish the prepaid card forms with the one valid ID and scan all these forms and submit it to us. From there, we shall initiate the issuance and delivery to your company office. Now, for the top-up process, the top-up process is relatively easy. All our company clients need to do is to fill up or encode all the details in the top-up file, which they will be sending to the PNB head office. And from there, our branch will execute and credit the necessary accounts within the same day. Now, to introduce to you our PNB debit card. Our PNB debit card is a payment card linked to a bank account that you can use to purchase, transfer balances, and withdraw cash. Now, it is a zero maintaining balance for companies who plan to use this debit card for their payroll solutions. It's also EMV or Euro MasterCard Visa enabled. It also allows the option to do over-the-counter transactions or internet and mobile banking. You can also access your balance or your account via our mobile app with 24/7 banking. And you can also use this card for cashless purchases at over 32 million shops around the world. It's also an ATM safe option for your security. Now, what you get or the benefits of this for payroll is that it is cashless and you also receive an immediate invalid notification in case any card fails. But what our product really shows or highlights is the same day credit, and it allows online posting within 1 hour of upload. We also allow weekend and holiday creditings up to the cutoff of 6 p.m. Now, our card holders, whether you avail for a prepaid or debit card, you may enjoy our services through our 670 branches around the Philippines, as well as the 1,588 ATMs around the country. So that's it for my presentation. I thank you for everyone who attended this webinar. I would like to give the floor back to Sir Mike. Sir Mike.
Thank you, Miguel.
All right.
So thank you once again, Miguel and Alvin. Ladies and gentlemen, our esteemed speakers have agreed to a Q&A for perhaps about 10 minutes. Please feel free to field your questions by first identifying yourselves, your companies, and the question. Or alternatively, you can use the chat box. So the Q&A begins now. Maybe to get the start, to start the ball rolling, I have a couple of questions. And this one's for Alvin. The projected GDP, even using the conservative figures, seem not too bad. They actually seem promising. And the rise in inflation does not seem to be that alarming as well. And the same goes for the depreciation of the peso, which seems to be manageable. So the industry whose fortunes are closely tied to the economy can still continue its forward trajectory. Now, to your mind, what can derail this trajectory? Is it a worsening of the East European conflict combined with the resurgence of new variants of COVID or something else?
Thank you. Thank you for the question. Both actually. Like I said a while ago, the key assumption that we made for this forecast is that the new variants, although can be more contagious, will not be more deadly or will not create worse complications than the current variant that is dominant, no, which is BA2. So, for example, if the current discussion now with Omicron XE is that it is more contagious than BA2, but at least at this point, it seems it is not more deadly, and it doesn't create worse complications. So because of that, the XE, even if it arrives in the Philippines, as long as the Philippines will not adopt a zero COVID policy, no, so like in China, then we should be okay. So let me summarize that. There are two components. What the government policy, that is zero COVID versus living with COVID, and the characteristic of the new variant. So for me, moving forward, those are the two things we should pay attention to. As of the moment, I think it is highly unlikely that the Philippines will adopt what China is doing, because it is obvious that the impact to the economy is something that we cannot afford. No? So regardless of who wins in the next election, I don't think anyone will do a zero COVID policy. So at least for that thing which is within our control, I'm not worried. So the thing that is outside anyone's control is how the variants will evolve. No? So what will happen, like I said, to your question, is what can derail is a new variant that creates very high hospitalizations, no? Because that's the thing that will force any government to resort again to very harsh lockdowns. The other part is, unfortunately, as we are, as we seem to be receding or exiting the pandemic, then we were faced with another problem. And the inflation of 4.7%, no, is not alarming. It's high, but if the conflict is prolonged, and even if it ends, but the sanctions are there, then it becomes a bigger problem. So what I mean, we have been fortunate enough for the past 15 years to be experiencing a very good inflation. But I think most of the people in this call are young enough to remember that inflation of 10% and 12% can happen. No? So unfortunately, that scenario, while I think is still low likelihood, is just around the corner. So to me, my advice is, let us just be cautious. There's no need to panic. But if there's one thing that everyone, I think, should be watching out for, is the possibility of inflation spiraling out of control. So just to repeat, we are not yet there. That event for me is still a black swan, meaning very low probability of happening, but high impact, no, when it happens. But it is a black swan, but it is a darker swan, if you will, this year compared to what it was in 2021.
So you think we should shift to gold instead?
Well, that would be a big, big shift, no. But basically, my view is that the government should manage the return or the openness of the economy. So, for example, there are simple solutions, right? So, for example, the heaviest hit by the pandemic, by the Russia-Ukraine war, was oil prices. No? So we have all seen that in March. But one thing that's the supply of oil. But what the government can control in a way is the demand for oil, meaning if hybrid work is accepted more, then the hit of high oil prices will not be as bad as it was before the pandemic, no. And indeed, I think that's one of the the byproduct of what happened to the Philippines. So in the US, no, just to compare it with the Philippines, they opened their economy earlier than the Philippines, and as a result, uh, their overall GDP as of end of last year was already 3.5% above the pre-pandemic. But that's only one side of the equation, no? But because global supply did not follow quickly, right? And because you had this war, then their inflation is very rose sharply, no? So can you imagine US inflation being double than the Philippines? If I told that to you 2 years ago, you'll say I'm crazy.
Yeah,
but,
exactly.
but what we're seeing now is that in the US, inflation is almost 8%, 880. In the Philippines, it's 4%. So they had the mismatch if you open your economy too fast without looking at the supply, then that would result, no, in yes, faster recovery, but consumers would have to pay in terms of higher prices. And of course, high inflation creates more high inflation, because when people see prices going up, they demand their salaries to go up as well, and then retailers charge more, no. So for the
Chain
Philippines, I think
reaction.
there's a chain reaction, exactly. So for the Philippines, I think there are low-hanging fruits that can be done, and my hope is that the policy makers, no, will realize this before it's too late.
Well, there is a huge elephant in the room, and it's waiting to be acknowledged. I'm sure the other attendees are likewise interested to know. Have you factored in the local political developments after the May elections? Like, for example, what can possibly happen if the pink wave candidates who it seems that business and economists seem to favor, or what about if the unity team wins, and will this bode well for the economy?
Well, my forecasts are colorblind, no? And the reason for that is not because it has to be, but one thing that we have learned, or the politicians, I think, have learned since the Arroyo administration, is that even if you are extremely unpopular, and she was, as long as the overall economy is doing okay, no? So it doesn't have to be great for everyone, but arguably during Arroyo's time, she passed laws that were unpopular, particularly the VAT increase, but it resulted in a sound economy. So as long as you do that, then you will be able to at least preserve your 6-year term, no? And so that's one. Secondly is a benefit of not having a strong party system, no? So in the Philippines, there are no Republicans and Democrats, right? Basically, the winning president creates the dominant party. A benefit of that, no, is that there is also less shifts in economic policies, no. So for me, those two things, no, makes our economic forecast agnostic to the winner of the presidential elections. What it is sensitive to is the smooth transition in power. So basically, what I am assuming is that regardless who wins, no, and of course, whoever wins, one side will be upset. That's for sure. But whoever wins, will the losing side, no, will not create a public or a popular uprising that we last saw, no, during the early 2000s. So as long as that is intact, our economic forecast would also remain.
Thank you, Alvin. There's a question in the chat box, and it's closer to home for Miss Agnes Ilaya. What or where is the best investment for companies to put excess or unused portions of their net worth?
So this is a personal, personal net worth, no?
No, actually, to give you a bit of a background, the insurance industry is undergoing a capital buildup program where our minimum net worth requirements are supposed to increase every year or so. So from maximum of 900 per company now, 900 million, by next year, we should be at 1.3 billion.
And the question is where to...
Yeah, where do we put that? Because sometimes you can't use it for operations.
Okay, and these are financial investments?
Yes, mostly government securities.
Okay, all right. So, okay. So, I suppose, no, because as an insurance company, there is a liquidity preference, no,
Yes,
for investments. Definitely at this point, I think, no, you should avoid longer term bonds. As I have said a while ago, benchmark rates in the Philippines and in the US are increasing, and that is a response, no, to higher inflation. Therefore, if you invest in longer term bonds, then you will be hit, no, by mark-to-market losses. So for me, it started actually last year, but it can go way up to maybe middle of next year until we have seen clear signs that inflation is going down, meaning the supply chain problems have been resolved, that the commodity prices have corrected back to the pre-war levels. Then I think bond prices, no, will continue to go up. So along the yield curve, I think the most prudent investment strategy is still to go to the shorter maturities. The good news is, at least now, no, because policy rates are increasing, then the shorter term maturities are now paying interest rates. Meaning in the US last year, if you place it in a 1 month government security, you will have no interest at all. By the end of the year, the Fed's policy rate would be around 1.75%, which means that a 1 year placement in the US policy rate will be on a 1 month US instrument will now pay you about 1.75%. So you get some yield, it's below inflation, but at least you're not hit by money market instruments. So still go and of course this is just a general advice, so it depends on the specific circumstances, but given that interest rates are rising and how high it can go is still up in the air, the most prudent strategy now is still stick to shorter term fixed income instruments.
Thank you, Alvin. So, ladies and gentlemen, are there any questions from the floor? Still have a few minutes. Let's not let this opportunity with Alvin go. Or any questions for Miguel as well, just in case you guys want to avail of the services of the solutions that PNB has to offer. Well, if you do, please feel free to contact them directly. We'll send you their contact and email addresses. So any questions? Going. Well, I guess that's it, Alvin and Miguel. So I guess this brings this particular webinar to a close. Do keep yourselves abreast on what PIRA, your association, has to offer via our periodic circulars or website, or alternatively, Facebook page. So please check on it every now and then. Once again, we would like to thank our guests, Mr. Alvin Narogo and Miguel Veneracion of the Philippine National Bank. Please do not hesitate to contact them directly should you have a need for their debit and prepaid card solutions. Alvin and Miguel will be more than pleased to assist. Till next time, stay safe and healthy and enjoy the rest of your afternoon. Thank you. Stay safe, everyone.
Thank you.